Dear viewers, it's time for another informative video to test your wits and financial prowess. Today we'll take you on a crash course and teach you everything you need about the income statement, balance sheet, and cash flow statement. Collectively, these are the foundations of accounting. Accounting is an essential tool and field to use in your business. Think of it as a cipher and compass to understanding and navigating the complex world of investing and keeping your businesses afloat. Learning some of these financial terms and concepts may be daunting at first, but once you've mastered the basics, it gets more accessible and more enjoyable. Stick around as we provide easy-to-remember definitions, analogies, and examples to help you better visualize how financial statements work. Ready those balance sheets and let's get accounting. Number 1. Income statement. A financial statement that outlines the company's revenue and expenses is called an income statement. It also displays if a firm or company is profitable or loses money over a specific period. We show income statements in the form of yearly or quarterly reports demonstrating financial patterns and comparisons over time. An income statement aims to demonstrate a company's financial success over time. It tells the financial tale of a company's operations. This financial tale allows accountants, investors, and business owners to study income statements regularly to understand how well a company performs compared to its planned performance. To better understand an income statement, we'll show you an image showing a fictional income statement and dissect all its parts. These numbers may not make sense to you at first, but knowing these terms would give you a clearer understanding of these numbers. Income statement terminologies. Income statements generally revolve around two major concepts, which are revenue and expenses. So what are these? Revenue is the sum of money received by a company during a reporting period. In other words, this is the total amount of money a business gets in a period. Its counterpart, expenses, are the costs incurred by a company during a reporting period. In other words, this is the total amount of money a business spends in a given period. We can further break down these two significant parts of an income statement into different segments depending on the company's needs. Gross profit is easy to understand as it's just the net sales or total revenue minus the cost of goods sold. Selling, general, and administrative expenses, or in this case, selling and operating expenses and general and administrative expenses, are costs that don't change or increase as a direct effect of selling more. Examples would include marketing expenses such as commercials, flyers, etc. They are also called total operating expenses. So subtracting the gross profit from the total operating expenses would yield the operating income. The operating income isn't the final income yet, as there may be some other sources of income that you may add or expenses that you may deduct. Once you've added in or subtracted these sources of income and expenses, this will yield income before taxes. To get the net income or the final income, you need to subtract income before taxes with the tax expense. The net income shows you how much profit your business has gained or lost over the quarter or year. Easy, isn't it? Number 2. Balance sheet. As the name implies, a balance sheet is for balancing numbers. But to understand it better, you must familiarize yourself with its components. Suppose your income statement shows revenue and expenses to determine how well your company is performing presently. In that case, the balance sheet gives analysts a glimpse of a company's present and past performance as well as its expectations for the near future. We can explain the balance sheet using this formula. Assets are equal to liabilities plus shareholders' equity. Let's say you have 100 units for your assets. To give you a short example, your liabilities might look like this. Liabilities 50 plus equity 50. Liabilities 60 plus equity 40. Or liabilities 70 plus equity 30. Any of these formulas are possible as long as when you add them, they reflect the total amount on the asset side. This is what it means to balance. Let's now proceed to understanding more of these components: assets, liabilities, and equity. What are assets? An asset is anything a business has that has a certain level of quantifiable worth which an owner can sell for cash. For example, if you own a restaurant, then that restaurant, including equipment, property, and patents, if you have any, are all your assets. These examples that we have are categorized into two: current and non-current assets. Current assets are any of the tangible or intangible resources that the company can convert into cash within the year. These resources includes cash equivalents, prepaid expenses, inventory, accounts receivable, and marketable securities. In other words, this is for the short term. Non-current assets, on the other hand, are any of the intangible or tangible resources that the company can convert into cash after more than a year. These resources are land, intellectual properties, patents, trademarks, and equipment, so long as value doesn't go down. These non-current assets are for the long term and can take between 5, 10, or 20 years depending on the amortization period. What are liabilities? The counterpart of an asset is what we call as a liability. These are resources not owned by the company but instead are resources owed by the company to a debtor. Let's use your restaurant again as an example. Let's say you can't pay upfront to put up your restaurant since you don't have enough cash. So you go to a bank or loaning firm, present them your plans, and say you want to borrow an amount of money. They review your financial history and can see that you can pay for the loan over the years or can see potential in your restaurant. So that money they lend to you to put up your restaurant is considered a liability since it's money you owe the bank or loaning firm. Like assets, liabilities are also categorized into two: current liabilities and non-current liabilities. Current liabilities are debts or money you owe which are due within the year. Examples of which are the salaries you pay to your employees. These also include accounts payable and accrued expenses or expenses that have accumulated and have not yet been collected. Non-current liabilities are debts or money you owe which are payable over a long period of time. Examples of which are loans, leases, and bonds payable. Like non-current assets, these are payable over 5, 10, or 20 years depending on the amortization period. Liabilities are not bad per se as you might think. They're part of your financial statements and are inevitable as you need them in order for your business to function properly or if you want some improvements done for your business. So long as you are able to pay your liabilities, then you won't have any trouble handling your investments or business. What is equity? This can also be called as shareholders' equity and shows the value or net worth of a company. The equity shows the total amount left if you paid your liabilities and sold your assets. There are some cases wherein you don't have the full ownership of your business and you may have sold some of your stocks to a public or private firm depending on the agreement you've made. These other owners are called as shareholders. The presence of shareholders usually makes balancing quite complex, but with the proper knowledge and data handling, less errors can be made. There is also an equation explaining equity and it is derived from the equation we showed a while ago regarding the balance sheet. This is the equation. Shareholders' equity is equal to assets minus liabilities. There are components to a shareholder's equity similar to assets and liabilities. These components include common stock, preferred stock, treasury stock, and retained earnings. It's best to calculate this data properly as miscalculations of equity can usually lead to an imbalance in the balance sheet. Balancing the balance sheet. There are 5 easy steps to start a balance sheet. These are simple enough nowadays since there are multiple softwares you can use. However, errors can still be made if the data is incorrectly entered or there are miscalculation in the amount, so it's best to check them manually too and to know the basic steps. Step 1. Know when to report. To do this, you have to determine first if the reporting period is done on a quarterly basis or an annual basis. For those done quarterly, it falls on March 31st for quarter 1, June 30th for quarter 2, September 30th for quarter 3, and December 31st for quarter 4. For annual reports, it usually falls on December 31st. Step 2. Know and identify your assets. To do this, separate your assets into line items or categorize them into current and non-current assets. Subtotal these categories separately and then total them together to give you a clearer breakdown of your assets. Step 3. Know and identify your liabilities. This is similar to what you did with your assets where you categorize them first into current and non-current liabilities and from there, subtotal these categories separately. Once done, total them together to provide you a clear breakdown of your liabilities. Step 4. Compute for shareholders' equity. If you have sole ownership of your business, then this is easy to do, but if there are shareholders involved, then this becomes a little bit complicated. However, just follow the equation shown a while ago where shareholders' equity is equals to assets minus liabilities. Step 5. Use the balance sheet equation. The last step involves the use of the equation we've shown a while ago, which is assets are equals to liabilities plus shareholders' equity. To give you a visual of a balance sheet, here's what it looks like from a theoretical company. Number 3. Cash flow statement. The cash flow statement lets you keep track of incoming and outgoing cash by displaying the source of that money. In other words, it shows you how cash moves in your business. For any business to thrive, we avoid one thing, and that is to run out of cash. And to run out of cash means to go bankrupt. So we try to maintain positive cash flows and we avoid our cash flows going negative. So what are the benefits of knowing the cash flow? First off, it provides a clear picture of your spending activities. Second, it keeps tabs on excess cash lying around. And lastly, it helps you focus on generating cash and helps you out in planning for your current state. So what makes up a cash flow statement? There are 3 important activities that shows how your cash moves. These are operating activities, investments, and financial activities. Let's look at them one by one. Operating activities. The cash flow activities known as operating activities are those that either produce income or keep track of the funds used to provide a good or service. Inventory transactions, interest and tax payments, employee paychecks, and rent payments are all examples of operational company activity. This section does not cover any additional sources of cash flow such as investments, debts, or dividends. Investment activities. The profits and losses associated with investments in assets like property, plant or equipment or PPE are listed in investment activities, which shows how the company's total financial position has changed. Analysts examine changes in a cash flow statement to determine the company's investment in PPE. Under investment activities, capital expenditures or CapEx are an important section. CapEx refers to the cash that a company invests on fixed assets like cars, buildings, or properties. A rise in CapEx indicates that the company is spending money on future operations, and it may show that the company's cash flow is going negative. This, however, may not mean a decline in the company's performance. There are cases wherein a negative cash flow is not an indication of poor performance. More often than not, this shows a possible high capital growth. Financial activities. The cash flow between the business and its owners, creditors, and other parties is tracked in the 3rd section of the cash flow statement. Transactions involving debt, stock, and dividends are all considered financial activities. In these transactions, the receipt of capital from lenders or investors, for example, means that it is recorded as incoming cash, and the payment of dividends means that cash is flowing outward. Positive cash flows. In the image below, numbers that are not enclosed in a parenthesis means that they're incoming cash. Numbers enclosed in a parenthesis means that these are outgoing cash and means that these are negative cash flows. In this example, however, operating activities and financial activities are showing positive cash flow. Investing activities are in the negative, but again, this is okay for investing activities since the payout comes at a much later date and we can probably see high capital growth in the future. Negative cash flow. Your business may experience negative cash flow when you have more cash going out than going in. This may mean that you need to borrow from lenders or banks in order to make up for the short in sales revenue. This means that whatever cash you have left would not be enough to cover for the costs or expenses to run your business. See the example below for your reference. Now that was doozy. There is so much to learn about the language of business, and what we've shown you here is just the tip of the iceberg. However, this can be of help if you are just starting to understand the ins and outs of business and would like to start one yourself. We've just provided you with the training wheels, and it's up to you to supplement that with more learnings. So if you want more informative videos like this, give this one a thumbs up and subscribe to be notified of new and upcoming videos. Again, this is Capitalist Domain, and it's never too late to keep learning about financial tips. Stick around for more.